Okay, well, thank you again for having me here today. So what I'm going to dive into and cover today is, how you can trade for some really big returns, but still keeping your risk very small. And this is using three really great option strategies called the butterfly, the condor, and the calendars. So, with this kind of market, everybody's noticed obviously how volatile we've been and how it's probably going to stay this way for a while. But using these three types of trade strategies are just going to be a great thing to add to your trading portfolio. So that being said, let's get started. So the following webinar today is purely for educational purposes. Any stocks, options, or futures mentioned does not constitute advice and should not be construed as a recommendation. Now, I've been trading actually options now for over 30 years. And, what I've found is that the most valuable kind of go-to option strategies out there that can help any trader or investor in any type of market environment, but especially when we start getting in extreme conditions like we are currently, is to utilize the option butterfly, the option long condor, and the calendar diagonal trace kind of spread. So they're what I call my trading secret weapon. Now, step one is that you want to, first off, though, understand how option pricing works. And that's going to really help you then to, maximize your profits. But first off, when we're trading options, the most important option factor really comes down to understanding the concept of time and volatility and the impact that it has on the price or the value of your option. Now, time decay is going to always work against buyers and it's going to benefit the sellers. And the reason is because, when we look at time decay and we define it using the option Greek called the option theta, it's going to either have a positive or negative value to it. So when you're looking at long options, so let's say you're long a call or you're long a put, they're going to have a negative theta value. So that's going to indicate they're going to actually be losing value as expiration draws near, and it really starts to accelerate. At the end of the day, at the expiration series, they're worthless. Now, the other side of that is that if you're short that call or short that put, they have a positive theta value. So that indicates that the position is going to gain value as expiration draws near, and that's going to be in your favor. So it's really important to understand that concept and then to try to utilize it and take advantage of it. Now, the other really major, pricing component is volatility. So the implied volatility is what is expressed as a percentage of your stock price. So indicating a 1 standard deviation move over the duration of whatever option cycle you're using. So in theory, a stock should end up within a kind of 1 standard deviation range about 68.2% of the time statistically, during the option cycle. Now, again, this is theoretical, but it's really the first place that we always start any option trade before we ever put it on. We want to know what is that expected implied move either up or down, and that's what we call it. So that's the next critical thing that you want to take advantage of and understand. Now, step two is trading time, and we can actually trade time by selling time to take advantage again of that option time decay or theta. So when we're selling options, it's kind of like you're selling the volatility and you're selling time. And you can kind of think about it as like a coupon that you get at a store. You get your coupon, you're checking out, and you see, oh, I've got 10, 15 days to use it, so I better use it up before it's no longer valid. So it's the same thing. Options are just like a coupon. They're going to have a certain amount of time, and then and then they're going to be worthless. So you need to understand that time and how it decays and the component that has an impact on the value of your option. So if you look at this kind of graph here, you can see when we're starting out, let's say we go out 120 to 90 days out, the time decay component is going to be very, very small. You hardly even notice it. But when you get about 30 days out, right about in here, 30 days from your expiration, day zero, that's where it really starts to accelerate. And the great thing today is, we've got weekly options. We've got a lot of different option series that we can use to really take advantage of that accelerated theta decay. And also, this is a benefit to buyers because we can buy options cheaper because the theta part of the option theta decay part of the price is going down as well. So you can buy some cheaper options on the other side, when that theta decay starts to decrease. So those are things that you want to be, aware of is how that theta impacts price and take advantage of that. Now, step three is, trading the probabilities. And so this is what I call the market maker secret. So, the option markets use, market probability statistics for pricing out the movement of your option to its expiration. And so by knowing the probability of your underlying security finishing within a certain range at expiration becomes key to then determining then what options you're going to look to buy or sell and what option strategies to use. Now, this forecast is what we call the implied move of your stock, or the implied expected move. And it's basically, again, that estimation of the one plus or minus standard deviation move over the current cycle of, whatever you're trading. So this is what we want to know first. Okay, what is our potential upside based on the theoretical implied move, or downside? And then that's going to help us to establish targets that are realistic within that implied move range. All right, so that's kind of one of the major steps we want to do, before we ever put the trade on. So if you look at this, this option platform here, you can see the option delta and the probability. So it kind of spells everything out. So here's an example. This is like Apple, okay? And so Apple at this, when this screenshot was taken, was trading about $190. Now, if you look over here, right here, you can see your delta, and then next to it is probability. That's actually saying probability out of the money. So if you look at this and you come down here and we look at Apple trading here at 190, you can see that the delta here is 0.52. So what that tells you is that if you're buying or selling that 190 strike, you've got basically a 50-50 chance, at 50% probability that price will be 190 or below, or 50 or 52% probability at 190 or above. So that's kind of helping you to determine and gauge what the chances of that trade would be for a winning trade if you're buying or selling that strike. Now, as you go further out, what you're going to see is, if you look at that 205 strike, you can see the delta here is 15. And then right next to it says probability. This is probability out of the money, says 86.5. So when we look at the option and the delta, when we look at a delta of 1, that is like equivalent to 100 shares. All right. So if you look at the 100 being the delta of 100, and then you look at here your 15 delta here, that's your kind of your strike there. The kind of reciprocal of that is 85. So what is that tells you is that theoretically there's an 85% probability that price will be below 205 at expiration. Or you could look at it the other way around and say, okay, I've got a 15% chance that price will be at 205 at expiration. So that's a really good way to quickly gauge, probability if your strike's being hit or not hit. And if you look here at that 217.5, you can see it says an option delta of 4, which says, probability of that is 96.59%. So really low probability that your price is going to get to 217.5. Now, if it does though, and you were buying these options, you're going to get rewarded because they're cheap, okay? And they're cheap because the probability of it being reached is very, very low. So these are things you want to make sure you understand as far as trading options, and to take advantage of that kind of, those kind of situations. Now, step 4 then is selecting the perfect option strategy. So let's take a look at some of the different ones that you can look at and use. And these are 3 of the best ones that I've found for trading, really any kind of market cycle or condition. But when we get into extreme cycles, like we're in now, 2 of the strategies I really like to go to is kind of the butterfly and the long condor. But we're going to cover all 3 of these here today, because this other one, this calendar diagonal, is one of my favorites. So it's just got a lot of flexibility to it. It's very diverse, just a very dynamic kind of structure to it. So first off, we look at the call butterfly, and it's called a butterfly because it looks, here's your body. This we call that the tent, the upside, the body is the top of the tent. All right, so basically what you're doing, you're combining 2 vertical spreads. So you might be a vertical call debit spread, and then you add a credit spread to it, and you've got a butterfly, or you could do it with puts. So if we're looking for an upside move, we're going to use calls. If we're looking for a downside move, we're going to use puts. So that's basically the the basic structure of what we call a balanced butterfly. Now, the other kind of variation is what we call the long condor. And this is a very, very similar structure to the butterfly, but it's widening out your potential profit zone area. So, the butterfly is great. It really reduces your risk and pops up your potential return. But, you're kind of threading a needle if you're trying to get it to, pin right there at expiration. So with this kind of structure, this is one we use quite a bit because it widens out that profit zone. We can widen that, really out a bigger zone to make it easier for us to hit. So that's one thing that's great about the Condor. And they both will give you a positive risk ratio, which means there's no time decay. And they're going to, give you, really good returns, positive risk ratio returns, where you maybe risk $1, you make 2. And with the butterfly, sometimes you can make, 15 to 20 times that dollar. So they're fantastic for, again, keeping your risk low, but providing you big potential returns. Now, the third one that I really like to go to is what we call the long calendar diagonal. So this is a combination of using a calendar, but with a diagonal component or a spread component to the trade. And these are just super dynamic and flexible, because what we'll typically do with this, we can go out further in time buying that long leg, and we keep adjusting, and we end up, a lot of times what we'll do is end up converting it to maybe the long condor or butterfly, and we may end up with a free trade by doing that. So this is a really, really popular one that we use a lot. So let's take a look at a couple of different ones here to give you an idea. So again, the call butterfly, we can use, puts or calls for it. And for an upside move, we're going to use calls. For downside move, put. But it's a limited profit, limited risk option strategy. 3 striking points. The butterfly spread can be constructed by calls or puts used. Called the butterfly because you're short the body, that top of the tent area there, and long the wings. Okay, so that's called the butterfly. Great for targeted swing trades. So if we're like, we think, let's say something's trading at $50, and we think there's a good probability for 100, we'll target that with the butterfly. That'll be the body. All right, so very great for high volatility markets, also great for high price stocks, because we can do these types of trades for very low capital at risk. Trade duration on these things will be, 1 day out to about 2 weeks is about as far as we want to go. Positive theta, no time decay, returns of all the different option strategies that are spreads out there. The butterfly will give you the potential highest return on your risk of any of the option spreads that are out there. So you can literally get 10 to 1, 20 to 1, sometimes even higher. Also great for hedging. So that's kind of the roundup summary for the butterfly. Now, when we look at the butterfly, again, it's going to be a combination of your vertical spread. So in this example, let's say you're long this call here and you're short a call here. So that's a vertical call debit spread, right? And your debit cost here is your risk of $300. So if you look at this and break it down, you can see then the potential here. So $10 wide spread or $1,000. Okay, so that $1,000. Remember, one option contracts equivalent 100 shares. The cost here, our debit cost, is the risk 300. So the potential here is to make $700. So that's a positive risk ratio. We're risking 300 or $1 to make 233% or $2.33. So nice positive risk ratio. Now, when we add a vertical credit spread to it, the other side of the trade, right here, we sell a call, buy a call here. Again, the spread width is $10 wide or 1,000. That's going to help us create the butterfly. So in this example, we brought in a credit of $200. Now the risk on this, though, is the difference would be $800. So that's a negative risk ratio. We're actually risking $4 to make $1. All right, so you might say, well, why would I ever do that? Well, the thing is, these are what we call probability trades, because there's a less of a probability that it's going to get out here to that 10-20 strike. If it had maybe say an A delta, that's giving you 20% chance to get there. So that's what we kind of call the probability trade. But when we add these two together, we get the best of both. Now we've converted, and now we've got a butterfly, and so we're long that call. We were long that call. We sell another call credit spread against it. Now we've got a butterfly. Here's your top of the tent. Now what we've done is we've, had the $300 debit. We have the credit here of 200. So now we've got a total risk. We've dropped that down to $100, but we still have the potential. It's $1,000 wide spread. Our cost is now dropped to 100. Potential is if it goes out the top or anywhere in here, we're going to make a good profit with the potential of $900 would be the max on that risk of 900. That'd be a 900% return. So you can see how quickly these things can, add up and go in your favor. So that's, the call butterfly. Now the long condor is just very similar, but, again, we're going to widen out the zone, that profit zone here. So we're going to have that wider zone to give us an easier access, to that profit. Now it's going to reduce the return on the capital, but it's also a really good one because it does have that wider zone. So that's the big plus there. Again, it's great for trading uncertainty, high volatility markets, very defined, great. This is a great one for hedging. We can adjust into hedges, duration 1 to 2 weeks out, that kind of thing. Your typical capital returns are 2 to 1 to 4 to 1. And again, no time decay, positive theta. So these are also great for that. So that's your long condor. We can use calls, we can use puts, we can go either direction with the condor just based on, either the calls or puts that we're using for the structure. So that's the other one that I like to go to. Now, the third one is this, what we call the counter diagonal spread. So a really great medium to longer term. This can be actually very long term. You could go out and buy leaps 2 to 3 years out to do this kind of trade. So it's a directional option strategy that is going to speculate on trend and also is great for hedging. So it's basically a vertical diagonal debit spread with a long option leg expiration set further out in time versus the short option leg, which is set closer into time to take advantage of that accelerated theta decay. So this takes advantage of that, accelerated theta decay from that short dated option. You're short that closer in versus being long further out. So that's going to have slower, less impact on the time decay, right? So that's what creates the vertical or the counter diagonal, and we can use it for calls on the upside or puts on the downside. So it has that additional vertical spread component, and that's what really adds the directional element for really great profitability. So what I call this is kind of like buying options at a discount, because we can kind of amortize, kind of like a covered call, but instead of owning the shares, we own the long dated option further out in time, and we just sell options against it, amortizing it down, and eventually you can amortize it down to zero pretty fast. So these are done for a net debit cost. So that's kind of what the structure looks like. You're going to be, it's kind of like I think about it as like a vertical call debit spread or something like this, but instead of being in the same expiration series, you're going to be long. The long series is going to be further out in time versus your short. So that short takes advantage of that accelerated theta decay. So that's the beauty of that one. And we can do so many different really cool adjustments. So let's take a look at some examples here. Now, these are trade examples for my trading room or the alert service that I run, and I'll give you an idea of, of what these look like. So using these types of strategies, I started my alert services back in 2018, and then I've added to it. But you can see that since inception through yesterday, we with the alert service, I've had 991 trades closed out. 705 of those winners, 76 break even, 210 losers. Now these are unaudited. So the win break even rate here since starting this, the services has been, running at 79%. But so far for this year, we're up about 84%. Okay, again, unaudited. This will win break even. So these are trades that I'll show you here. A couple examples that I send out to the alert members, and these are kind of some of the spreads that we might, send out. This is one that was on a QQQ, what we call a wide wing butterfly. And, this was, the market was breaking down. I may kind of have to speed up a little bit here so I can get everything in, but, it broke down right here. So we were kind of targeting down in this area about 305, 304. This is like a 50 simple moving average. All right, so we were targeting down there. So there's the body of the butterfly was our target area here at 304. So we did this with puts for a downside move, and it's 314, 304, 304, 294. So that's a $10 wide spread, right? So $10 or $1,000 wide. The cost of this trade was $2.10 or 210 bucks. So if it was to go out at our target, that'd be a $790 per spread profit or 376% return. So much better than if you just did the outright short QQQ. You would have made about 3.76%, versus this one making 376%. So you're basically risking $1 to make $3.76. So this one went out right about here. You can see right there. So it was up about $572. Okay, so the spread blew out to 782. Cost was 210. There's the profit per spread. That was ended up about 272% return, on that butterfly there. Now here's a really cool. This is one that we did just recently. This was on we started this with a long calendar diagonal on Apple, and then we're able to adjust this to a long call condor, and had a huge return on this. So I won't go through the detail, but this is, what the alerts come out looking like. This is using what we call Telegram. And so set this up, Apple was trading here at 263 and set this up with using a long counter diagonal right here. And then did a couple adjustments on the 3rd, did another adjustment on the 5th, and then adjusted this into what we call the long call condor. And we had super reduced low risk. And then on the, the 11th, had this trade taken off. It was trading up around a profit of $278, $280 per spread. So actually it was up about $910 per spread. So it was up over 1,000% return. So that's the potential that you have with these types of trades. So here's the trade setup right here, did adjustment here into the call condor. And then here it went out right there, and that's where we had our profit. So this one was basically adjusted this into this long call condor. So we ended up with the trade long the 267.5 call, short the 280 call debit spread. Okay, so that looks like that, and then short against that. The final part of the adjustment was selling at 287.5, long the 300 call credit spread. So we had this. So we had a really wide long call condor, and since we did some adjustments, we took in huge profits from adjusting the trade up, and we were able to adjust down our cost to a cost of just $75 per spread. Okay, so that was the max that we had at risk after the adjustments was $75. Now the potential max profit was if it went out inside here, that would be your max profit return, and that would be up $1,175. If you hit that, that's over 1,500% return. So that's what you're looking at with these types of trades, super low risk with potential for a huge return. And here's where it went out. So this was one that really, really did really well. So it went out there on the 11th, traded at 278 to, about 279. Spread blew out from 75 adjusted cost to 294. So this was up $919 per spread, a 1,225% return on that from the adjustments and everything that were done there. Now here's another one that this was one that we just set up, and actually we're still in this one because we've adjusted this into a long call condor, which I'll show you here in a minute. But this was one on Palo Alto, and we set this up on the 4th. It was trading at 157.5. And then this is just to show you where it was with the calendar diagonal spread. Before we adjusted it, it was trading at 163.25, and I'll show you what this looked like. So set the trade up initially right here, had a nice breakout, and then just a day later, this thing had ripped to the upside, and now it's trading here. So we had this profit one day later from this counter diagonal part of it. It was trading there on the 5th, 163. So this went from our cost of $380. Now it blew out to 691. So we're up $311 per spread, 82% return on that. So that is a really cool strategy. Now, let me show you where it is currently. I'll just pull it up here real quick. PANW. Let me pull that up and I'll show you what it's currently looking like. So here is currently, we've adjusted this into this long call condor. And let me show you what it's currently has locked in today. All right, so we originally set it up right here, okay? Did a number of adjustments, and now currently today, this trade based on the adjusting it into the long call condor is, this thing is up. Let me pull it up here. This trade is currently up about $440 per spread, okay, on that risk of $65. So, you know, if we were by this Friday, you know, it was to go out between our two spreads right here, this will be up over $935 on that risk of 65. So you can see these things have really great potential, great flexibility, just a super great strategies to add to your, you know, whatever your trading profile, your trading game plan or portfolio. All right, so just kind of wanted to show you that. So, you know, today was just kind of a beginning, but if you know, what I covered today only scratched the surface of what's really truly possible. So if you're, you know, ready to go deeper, here's your next step. All right, so I've got this course for everybody. This is an on-demand course. This is a course, a live course that I did not too long ago called the Option Strategy Playbook. So proven directional option trade strategies for trending and reversing markets. So it's a 5+ hour course that you know, I did, and I've got some really great enrollment bonuses for everybody. If you'd like to sign up here for today, use this link here. I'll show you whatever what you're going to get. This will be yours, you know, for forever. You know, we'll give you a login, and you can just, you know, log into your area and get access to your course, whatever. So just use that link there, click on it or copy and paste, and that'll pull up a drop down where you can then, fill it out and make your payment. So here's what it, basically look like. You can use PayPal, whatever, but here's your payment link once you copy on that link, and it'll show you everything here that you're going to get, for that price of $197. And if you also want to add my indicators, you can also add those here. And it's a 5 set directional trading model indicators that I developed and used. And it's available for Thinkorswim, TradeStation, Ninja Trader, TradingView, eSignal. So I've got those, set up for you. So if you'd like to join us here, and now this is what you're going to get, with this special promotion today. You're going to get the full course. This is my Ultimate Option Guide course. If you go to my website, powercycletrading.com, you'll see the price on the website is $597 just for the course. But today, everybody that signs up, you'll get it for $197. Now, in addition to this lowered price here, 67% off, you're going to get a 30-day trial membership to my trading club. All right, so this is going to give you access to my trading room and come and see what we're doing on, during the day. If you have questions on any of your trades or see what we're doing there. And then we'll do a live follow-up Q&A, that you'll be invited to for this. So we'll send you out a link for that. You're also going to get my option trading tutorials, a really nice option tutorial on options, videos and PowerPoint on that. And then I'm going to give you my option strategy manifesto. So there's 15 other option strategies that you can look at and tells you how they work. You'll get that. And then future, if I do, this course in the future, you're going to get an invitation to the live course, and you're going to get that for, you'll only have to pay $97. So, total value of all the different bonuses added up, $638 plus the course here, over $1,200 here, and today $197. So just put in that powercycletrading.com smallcap/trade1, and you'll have access to this course and all those bonuses. So here's that link again if you need that. So let's go through what you're going to get. So first off, you're going to get the course. It's a 5+ hour course broken down in modules of 30 minutes or less, kind of like a chapter of a book, with the PowerPoint training manual of the course, over 430 pages there. So step-by-step guide and of the course of all the different option strategies. So let me go through what the course covers. So part one of the course is the foundation of your option trading. So and this part of the course go through the option Greeks that you need to understand, theta, gamma, delta, those particular Greeks, how your option pricing works, and then your probability analysis that we use for selecting your probability trades, your profit targets, things like that. So there's a lot of detail there. Now, the next part of the course is which strategy to use and when. So this takes you through how to select the right option strategy based on the market cycle you're in. Are we in an uptrend, downtrend, or sideways? And then it also I cover 5 chart patterns that I like to look for, which is part of how I select option strategies based on a chart pattern. And then what is the condition we're in? So there's always some kind of market uncertainty. So this helps you to quantify the extremes of the condition, high, low, or extreme. And then this is all going to then help you to gauge what option strategy to use. Now then part 3, I go through these various strategies here based on when to use them on market cycle, market conditions, and your time horizon. So the course covers your vertical debit and credit spreads, the butterfly spread, the long condor spread, the counter diagonal, and synthetic long, which is a really awesome, cool strategy as well. So it covers all these strategies in the course. So it's a very, very detailed option course that you're going to get a heck of a lot out of. Part 4 then also goes through how to use these strategies for hedging. So I call it kind of the progression of hedging, and then how to use that long condor defense for your hedges, the butterfly defense for hedges, things like that. So a lot of great content there to help you on your hedging. And then part 5, you'll have in the resource part of the course, how assignment risk works, exercise and auto exercise works, more on the option Greeks and more on standard deviation with a really great trading library. So you can go back in and see past trades, which will help you learn how to use these strategies as well. So with this course and with this package here today, you're going to get access to my trading room, 30-day trial membership. You can start it whenever you want. So you'll have access to my trade room that's open Wednesday through Friday, 9:30 to 10:30 Eastern. Then you'll have access to my daily video newsletter updates every day after the close. We have a trading trades are archived, so you can go back and look at those. Access to our weekly live and recorded Q&As, Traders Educational Vault, and anything on my website, 50% discounts on anything on site, courses, and all my software. So a lot of great stuff there. Bonus 2, we'll do a follow-up account ability support Q&A, which you'll get access to. Plus, you're going to get the trading room for the next 30 days. So you get that. 3 is you're going to get this how the pros use the Greeks. So it's a really nice little money tutorial on the Greeks, 60-page guide with videos on how to, delta, gamma, theta, option pricing, more on standard deviation, option delta, how all that stuff kind of works together to, make you a better trader. And then bonus 4, my top option strategy guide. So here it breaks down. Have you ever wondered what is a back ratio spread or a vertical ladder spread? So it's going to take you through 15 other different option strategies that'll go through and kind of help you better understand what these are, what conditions of the market you might want to use or look at using these kind of option strategies as well. So that's another thing you'll get. Plus, like I said earlier, if I do this course in the future, you'll have access to the course for $97 on any live course that I do, in the future. And then a simple and brief option guide. You put this on your desktop. It gives you, the delta, gamma, theta kind of describes all these, so you can just have a quick access. So it's a lot of great stuff for you here, and hopefully you'll jump in and take advantage of it. And hopefully I'll see you in my trade room tomorrow or sometime this week. So make sure to take advantage of it. Go here at powercycletrading.com/trade1, and you'll get for $197 all this plus a fantastic course, which will be kind of your go-to blueprint course for a lot of really great option strategies that hopefully you'll start to get into and use. So that's pretty much everything there. Any questions here, I'd be happy to answer. I've got a couple minutes left. And if there's anything else here, let me know, and I'd be happy to answer. Okay. There seems to be none, but again, I appreciate everybody's time here today, and hopefully these will be some things you can look at in the future. Yeah, if you go to my website, you'll see all the kind of, let me pull that up. I do have a minute here or so. So you can go to my website and you can check that out, all the different courses that I offer, my trading indicators, my trading software. But here, you know, my trading courses, if you go here, you'll see trading courses, and you can see here this option strategy guide right here course. Let me see, I'll show you, was you know, $597 anyway. It's right here. Well, anyway, I've got a lot of great option courses in here, so go out there, check it out, and I look forward to working with you guys and gals here in the future. So again, good luck trading, and all the best. Appreciate the invite to be here too. Thank you.